Peter Walker's definitive work, The Journey Revisited. Dog-eared, yellow stickies, paper clips. And I opened it up in front of the North American Zurich CEO, and I said, I think this is the model for how to win, and I want to know whether you agree with me. And Mike Foley worked for Peter for some years before he took over the North American role. It turns out he agreed completely, because his next thing was, when can you start? So I've always been very deeply grateful to Peter for writing such an insightful piece and helping me sell my way into the fabulous gig I've got today. So Joel Baker asked me to be on the organizing committee for this conference, and my one contribution really was to say, why don't we try inviting Peter Walker to come here? And like, he's a global McKinsey rock star. He's decades of expertise on property casualty. And so I sent an email, and then we had a phone call, and he said the sweetest thing, apart from yes, which he also said, but he said, I've always meant to take a look at Canada, and I just never have. And so this is a great opportunity. So I'll have my team work up the Canada numbers, and we'll come and do this show. And so Peter and his team, Sasha Guy, will be presenting this afternoon. I've had a chance to take a look at the deck as it evolved. It is what you would expect of a high-end McKinsey piece, but I would say that the final slides that Sasha gets to present that show the unique analysis of the Canadian market are by themselves, knowing what McKinsey charges, worth the price of admission. And so without further hesitation, it is my pleasure to introduce one of the deepest thinkers on our industry on the planet from McKinsey, Peter Walker.
Geez, I wish my kids were here. Anyway, when Alistair called, I had been kind of playing around with the idea that something was different in this industry, and had been formulating what we call Journey 3 for quite a while, but never really got around to connecting all the dots. So it was a great opportunity, so thank you, Alistair. It's gotten where it is because I knew I'd be up here today, and I didn't want to embarrass myself. So by way of background, I'm a life actuary. I discovered at a relatively early age that being a life actuary was a little boring because you generally knew when people were going to die on average. You didn't know who was going to die. That would have been a lot more exciting. And so I served my first property casualty client in North America. Turned out to be Chubb. This was back in the early 70s. And I really got hooked from a great line from the CEO of Chubb at the time, Henry Harder. And Henry said to me, Peter, think of property casualty as a big legalized bookie operation, and my underwriters are my bookies. And I said, I really like that concept. So anyway, one of the things I reflected on in the P&C world is whenever you connected with senior executives, the buzz was always around what deal was going to be done, who's under-reserved, what the cat season's going to bring us, whose balance sheet isn't going to hold up, who's buying the business. But there was never much discussion about just the fundamentals of what are the returns in this industry and why, who wins and loses in this industry and why, which really was the motivation for doing the first Journey piece. So what I'm going to do today is basically start by doing a very brief recap of the Journey and the Journey Revisited, then talk about the fundamental paradigm shift that has taken place in this industry, which I think the enormous increase in profits has foretold. And then I'd like to talk through what we see as 3 implications for that paradigm shift, and then close with, and I'll be doing this purely from a U.S. perspective, and then, because I know enough about Canada to be dangerous, and then I'm going to turn it over to Sasha Guy, my partner, who heads up our insurance practice in Canada, to talk specifically about what's similar and what's different in Canada and what are the implications. So if you go back to the journey, the original journey really put forward two ideas. The first idea was, and this is back if you go back to the 80s when we were talking about double-digit interest rates, inflation rates, enormously hot and volatile equity markets, there were an awful lot of theories of the case as to how you made money in the property casualty business. So there were people arguing it was all about scale and was all about M&A, and the bigger you got, the better you were going to get. There were people who argued it's all of that underwriting and claims and investment are all commodity-like. It's all about managing costs. So the lower the cost, the expense ratio was, the better off you were going to be. There were clearly the folks who believed in cash flow underwriting, that it's simply, this is a free cash, a free source of float, and let's just put it to work as best we can. And certainly that was the model at CNA, that was the model at Reliance, that was the model of a number of other firms. What we basically demonstrated in the first journey is that no matter how you do the analysis, the only thing that correlates in a meaningful way with wealth creation in this industry is underwriting performance. So that was the first kind of core idea. The second is that getting risk right, we said, is difficult because there are a lot of ironies of risk. One of the first ironies that we pointed out was that really good underwriting companies seek risk. They don't avoid it. And Hank Greenberg was always the best at doing that. Another irony of risk was don't try to anticipate and manage the cycle. Ignore the cycle. Get every risk right on its own terms. And you will inevitably write more business in hard markets and less in soft markets, and that'll take care of itself much better than gaming the cycle itself. And there were a number of other things that were a bit counterintuitive. We then turned forward the hands of time at that point to the early 90s and looked at what happened in the 90s and put together the Journey Revisited, which took a more microeconomic and macroeconomic view of industry results and specifically the results of individual companies. And there were a couple of things that I know when I first saw the numbers surprised me. One was what an abysmal industry this was in terms of returns. Everything in red that you're looking at there basically means the industry did not cover its cost of capital in that year. And you can see how little green there actually is. And then when you looked at property casualty, which you could argue is riskier than any of the other financial sectors that are up here, this is an industry that was running returns that were half of the rest of the financial services industry, which immediately begged the question of, but why have so many smart people gotten into this business? So thinking Warren Buffett, Sandy Weil with Travelers, Hank Greenberg, the Tisches. And the answer is the spreads in this industry in performance. And here we're looking at returns for each of the 5 quintiles when you take the top, I believe it was top 25 companies that we looked at. If you were to do this spread in almost any other financial sector, it'd be roughly half the bandwidth. So enormous rewards for winning in this industry, enormous penalties for being a poor performer. And I would argue that's because this is one of the most inherently complex businesses that there is. People in the outside world don't understand that. But when you look at what goes into underwriting a complex risk, when you look at what goes into the rating engines in personal lines and in small commercial, when you look at the variables and the stakes, when you've got attorneys settling high-end litigated claims, the complexity in this industry that's highly decentralized is like almost none other. And to me, that's what this chart speaks to. Now, going back to the point of what drives returns, we then said, okay, how much of these differences in returns by quintiles are due to differences in underwriting performance. And when I use underwriting, I'm using the term very broadly to include claims, underwriting, pricing, everything that determines ultimately your combined ratio. And you can see from the first set of bars, there's an enormously strong correlation between wealth creation and underwriting margins. The second looks at investment performance, and you could see that on average, the top companies perform somewhat better in investments. And the final column is economic leverage, premium surplus ratios, which for the quintiles were almost identical. So to us, it was a very strong reinforcement of the notion that this business essentially is all about managing risk. And then we went through in the Journey Revisited and talked through what it took to be successful at 4 very different levels of managing risk. The first and most relevant to the panel discussion is dealing with risk at the enterprise level. And it's literally what's the frequency and cost of things that can go bad. And it can be your balance sheet, it can be CATs, it can be cumulative hits from A&E exposures. There are many things that can go into it. It can be investment portfolio, obviously. The second one is capital management, which is the enormous importance of where companies choose to make their bets. And if you go back to one of the ironies of risk that we focused on in the original Journey, conventional wisdom would say, well, you want to spread your bets because that diversification will give you minimal volatility. In fact, when you look at the best underwriting companies, they completely concentrate their risks. They make much more binary decisions in or out, don't just hang around. And certainly when you look at the portfolios over time of an AIG and of a Progressive and of a Chubb, they are in or they are out, and where they're in, they tend to win. The third level is product market management, which is rating engines, product design, support systems and MIS, distribution strategies, underwriting algorithms, all of those things that go into shaping the actual decisions made at a transaction level. And then the final level is transaction excellence, which is getting it right every time. I had the fun experience when Bill McCormick, who used to run cards at American Express, was given Fireman's Fund. He knew nothing about the business. So we said, why don't we spend an afternoon together? So I did. At the end of the day, he said, so let me see if I've got this right. This is like running a grocery store where the price of bread is set by the checkout clerk. And I said, that's a very good analogy, Bill, which is why this is such a complex business. And then we finally closed the Journey Revisited talking about 3 underlying pillars that ultimately drive performance. One is performance management. How high are the goals? How granular is the analysis when you miss goals? And what are the consequences when you miss goals? The second pillar is financial disciplines. How you manage reinsurance, how you manage your cost base, how you manage your capital. And then the final is talent, which is the ultimate underpinner of them all, which is the quality of the management team starting at the top and working its way through the layers. So what I'd like to do now is to basically show you what has caused me to believe this industry has gone through in the U.S. I think this will happen in other industries, but it's happened in the U.S. first, maybe as the largest and most mature market. There's been a fundamental shift in the profitability of this industry that we would argue is not going back. So when I talk to executives who say, and I say, how's your growth look? And the answer is, we're keeping our powder dry for the cycle turn. And my response is, you're going to have a long wait. And if you look at this, you can look at 08 and 09, which are fully reported results. But what's much more striking is when you normalize those results for CATs and for realized capital gains and losses. And when you look, and this is all inflation adjustment, so what you realize is that after 5 absolutely record years, much longer, hard market than you would ever expected before you got a turn, you still have '08 and '09 coming in with higher profits adjusted for inflation than any prior year back to '88. So we basically say, this is not an accident. This is not a confluence of events. Something fundamental has happened, which then begs the question of what has happened, and that will enable each of you to decide for yourselves whether or not this is a paradigm shift or not. The first thing that has happened is the exit of undisciplined capacity. If you look at the size of these companies, and this is their premiums when they were writing before they went under, these are all billion-dollar-plus companies, all household names in the market. They went under for different reasons. Some of them had counterparty exposures and reinsurance that took them others. Others had, deep asbestos and environmental exposures that deteriorated their balance sheet. But the net effect of it all is that capacity was taken out of the market. All of that business was rewritten by the rest of the market. So you pull out of the industry results the numbers of these companies, as well as imagine the full repricing of all that business on a much more sound basis. The second thing is, and here, having spent time with major companies over the last 35 years, we just see a very fundamental change. I can tell you that when you talk with chief executives going back not that many years ago, but let's say 10 years ago, and you say, how's commercial lines pricing holding up? And they say, oh, we think pricing's fine. I said, no, give me some numbers. And the answer typically was, you'll have to talk to the actuary. Today, when you talk to chief executives in this industry, they will tell you exactly what the percentage change was last month across the commercial book, how much was price, how much was exposure, exactly what happened to renewal retention. So the depth of understanding at each of the four levels of risk, we would argue, are fundamentally different than they were before. And let me just walk our way through the pyramid. If you look at the enterprise level, the knowledge of catastrophes. I remember talking to someone from Prudential way back when, and I said, so how do you feel about your cat exposure? And they said, we feel great. We have only 1% of our premium in Florida. What he didn't know was they had 10% market share in Homestead, Florida, which took Hurricane Andrew head on, and that one storm completely wiped out their capital base. Today, when you ask people about their cat exposures, thanks to the models and the work the reinsurers have done, they will tell you by construction code, by neighborhood, Force 3, Force 4, Force 5, exactly what the exposure is, and can manage it at a level of detail that's very different than it had been historically. Same thing on the investment side. If you look at the hits the investment banks, the commercial banks, and the life insurers took in the financial meltdown, it was a tiny blip in the property casualty industry. And the reality is, I think most of the top management teams say we take an awful lot of risk in our everyday business. Why double down in the investment portfolio? Much more understanding of accumulations that in a way that didn't really exist if you go back 10 or more years. So we see enterprise risk management going back to the broad definition of the frequency and cost of surprises as being far more sophisticated. In capital management, it's harder to point to a sea change. All I can tell you is that most of the clients that I spend time with have an increasingly low tolerance of businesses that do not cover their cost of capital. And I used to hear all the arguments, well, we're a national company, we're a big company, well, we think the market's going to turn, and every reason you can imagine to keep someone from exiting a market. And yet, when people started to exit unprofitable markets frequently driven by regulatory action, what happened? The regulators were left with no private industry. They realized this was a unattractive business for the government to be in, and within the next 5 years, we're welcoming companies back into assigned risk or whatever it was. So I think one of the best ways to rationalize markets is for companies to withdraw capital when they cannot cover their cost of capital, hand it over to the government and say good luck, and within a relatively short period of time, they will understand that there's a reason companies needed their prices. If you look at product market management, again, far more sophisticated rating engines. So I don't know how many cells Progressive would have today in pricing their automobile business, but it's probably 1,000 times the number of cells they would have had 10 years ago. If you look at small commercial, which is dominated in the U.S. by Hartford and Travelers, it is getting as sophisticated as personal automobile in terms of multivariate rating plans that select the most powerful predictive factors from all of the factors that they keep track of. If you look at the price monitoring that's going on, far more sophisticated than it's ever been. It used to be terms and conditions were what really hurts you in a soft market. Now most companies price terms and conditions. And they may compromise on conditions, but they understand what the value is, and it goes right to the top. So in terms of product market management, far more sophisticated, and the same thing, transaction excellence. Companies that have done detailed analysis of claims payment against best practices standards can tell you exactly what their leakage rates are by line of business, by geography, and that enables them to focus attention within claims on those aspects of which lines of business and which parts of the settlement process. Is it a coverage verification issue? Is it an investigation issue? Is it an evaluation issue? Are we missing recoveries? So you add all those up, and I would say to the extent companies are willing to compromise on price or use what I would call classic soft market behavior, it won't be because they don't know what the value is they're giving up. They know. And that's why when you hear, and I hear the same stories, we expect renewals are going to be off 5, 6, 7%. It's not happening. So companies are very upset that they're not able to keep pace with inflation. But at the end of the day, when you're running 11, 12% returns, and you look at where interest rates are today, a lot of people are saying, that's not a bad spread. And the ideas of getting used to 16, 17, and 18% is totally unrealistic in this economy. And then the final change is in the foundational pillars. And so here we would say, and again, this is hard to assign numbers to, but I would go back to the bottom one of these pillars, talent, and tell you that a Travelers under a Jay Fishman is a very different company than the old Travelers. ACE under Evan Greenberg is a very different company from the old ACE. Zurich today is a very different company that was when you look at their combined ratio performance, where they probably gained 6 to 7 points against competition. CNA under Tom Matamid, vice chairman of Chubb for many years, is a different company. So I won't go through the other levers, but when you start with CEOs who come from environments where they are used to high performance and attractive returns and are very tough-minded about capturing it, it changes the nature of the institution. And one of the things I love to ask when I visit with senior executives is, who's buying the business? And it used to be when you'd ask that question back in the 80s, early 90s, they could say, Reliance is buying the business, Home is buying the business, CU is buying the business, Royal's buying the business. Today, you get no consistent names. For a while, AIG, when they were under threat and Chartis was pointed to as buying the business, but every time I heard a name and went back and looked at their premium growth rate for the last quarter, in the good old days of a soft market, you would have seen companies that were growing 5, 10 points faster than the market. There's nobody doing that in the U.S. market today. So what are the implications for companies? The first implication is, and it was funny because I sent over an early version of the Journey 3 to some friends at Lloyd's, and one of them called me and said, this is very distressing. And I said, why? And he said, well, what you're saying is everyone's getting good at managing risk. That's how we make our money. So our source of competitive advantage is disappearing. And I said, I don't think that's the case. I think what's happening is everybody is raising the bar. And in fact, the best underwriting companies are raising the bar even faster than the weaker underwriting companies. So to test that, we took the quintiles and broke the last 20 years into 4 different 5-year periods. And this is the spread between the bottom quintile and top quintile companies. So you can see there's no evidence that the gap is shrinking. Now, I will argue that ultimately, if I were here 10 years from now, I think it will start to shrink. Because certainly if you look at the most commodity-like product in the U.S., which is personal automobile, Progressive used to kill the industry in combined ratio, and their pricing plans were so much more sophisticated than anyone else's, originally in substandard, but then they moved into the standard lines. There's only so long you can play that game out and maintain big margins. So now when you talk to most of the major carriers in the U.S., they have somewhere between 3 and 5 ex-Progressive actuaries who are trying to out-Progressive Progressive. So ultimately what happens is the ability to differentiate on that basis gets increasingly narrow. But we would say that there's still an enormous amount of room to run. We would say to our friends at Lloyd's, you will be well compensated for being superb in risk for a long time. But it does raise the question, in those lines and markets where the gaps start to narrow, what is the source of competition going to be? And this is one of the core points we want to leave behind. This is a very unsophisticated industry when it comes to managing growth. So if you could imagine sitting down with your top underwriting executives and saying, what's going on in the general liability book? What's going on in the homeowner's book? And their ability to slice and dice by producer, by class, by limit, by geography, by accident year versus calendar year. Most of the good companies can tell you almost anything you'd want to know. You could always come up with another variable, but the level of sophistication compared to 10 years ago is huge. If you were to ask those same questions on growth, so what would happen if a CEO said, what do we spend on product development and enhancement, and what's the return on that investment? I don't know of a single company that can come close to answering that question factually. What are our cross-sell rates? What is our renewal retention? The first thing you get into is a debate on how do you define what's renewal retention? Is it a policy level? Is it an account level? Do you measure by premium? Do you measure by policies? So one of the core points that we would like to leave with you on this one is that really getting good at growth in the same way the industry has gotten very good at risk is in and of itself going to be a long, tough journey. And that's what I'd like to kind of walk through now. So this is basically meant to depict, and these mountains don't look very sophisticated because I think the ink's still dry or still wet on them from some people working away the day before yesterday. But what it's trying to illustrate is that there are 2 different mountains to climb. One's a risk mountain and one's a growth mountain. The first thing I would leave you with is anyone who starts to climb the growth mountain who has not completed the risk journey is doomed. And we've seen a lot of companies prematurely believe that they can start growing in a marketplace before they've earned the right. And by climbing the risk mountain, we typically mean companies that are at least in the upper half in combined ratio or operating ratio performance among their peers. But for those companies that have climbed the growth mountain, the risk mountain, we would argue there is a journey before you even start the growth mountain. The first is mindset changes. And what do I mean by mindset changes? So I'm going to show you some analyses that will deal with some of the conventional wisdom on how you think about growth. The first is high growth companies compromise underwriting standards to get it. How else do they grow? And this is a long-term correlation over a 10-year period of time of growth versus operating margin. And you can see the R squared is 56%, which is quite high. But one of the things that I would argue is the U.S. is becoming an increasingly disciplined market. The number of companies, the way you can gauge discipline looking at this curve is The solid line, which is the regression line, is basically the growth rate you have earned based on your underwriting performance. So the better your underwriting performance against this curve, the faster you ought to be able to grow. And so the irrational players are the players who are materially above the line, unless there's some extraneous explanation. But overall, you look at that chart and you say, this is a pretty disciplined industry. There aren't that many above. Many of those above are in the upper right, so they clearly know what they're doing from a risk point of view. There's nobody in the top left quadrant, which is very encouraging, growing well beyond what they've earned. And the others that are in the lower left above the line aren't ahead by that much. So that's one point. Second point is, for those waiting to keep their powder dry, we would say, if you look back at the cycles, I mean, realistically, we've only had two meaningful hard markets. We had the liability-driven hard market, which was back in the mid-'80s, and you can see there was an enormous run-up in industry premium over that period of time. And then we had the hard market in the 2000-2001 period, which was triggered by a lot of different things. It was triggered by significantly underpriced excess casualty reinsurance in the marketplace, which lulled an awful lot of primary companies into making some false decisions in their own pricing. You obviously had 9/11 and the view that 9/11 was creating a terrorist exposure which originally focused on marquee buildings in the top 5 cities and quickly became, terrorist loads for condominiums in Iowa. So you can see the industry had, in retrospect, a significant overreaction to that exposure. And then you also had the dot-com bubble, where you had probably $1 trillion of market cap destroyed in the dot-com bubble, which immediately triggered an enormous number of shareholder suits and D&O exposures. But we would argue that as the industry has gone down the risk curve and has gotten increasingly sophisticated at each of those 4 levels, and is still writing, I would argue today, with twice the capacity that it needs to underwrite the risk that it's actually exposed to, because the regulators don't really understand, and certainly the rating agencies don't understand the economics of risk in this industry. So if you've got all that excess capacity and you've got those skills, and you look at this pattern and say, when is it going to turn? My attitude is it's not. Will there be selected cells where it turns? Yes. But in terms of any significant lift that would actually move the needle and create a dark shaded area, as we show on this curve, we think it's highly unlikely. And the third chart is, if the industry has run for as long as it did, covering half its cost of capital, growth destroys wealth. In other words, if you're not covering your cost of capital, which in this exhibit I think we used 98 as, I forget what interest rate we used, but cost of capital would have been around 10, 11%, something like that. So you can see that in this model, if you were writing at less than or worse than a 98, every dollar of growth destroys value. So there was no incentive when you looked across the industry other than for the really good underwriting companies like a Berkeley, like an AIG, like a Geico, like a Progressive to really focus on growth. But now you've got a number of very well-managed companies running in the high 80s, low 90s. And what this curve shows is that increasing the growth rate by a point or 2 or 3 in terms of market expectations creates a very significant lift in shareholder value. So we think for those 3 mindset reasons that it's completely consistent and correlated with underwriting excellence, that cyclical turns are unlikely, and if they happen are likely to be very modest, and the economic value of growth is huge when you can get your combines in the low 90s, high 80s. Now, there are a number of barriers once you get the mindset change that companies have to overcome. The first is the analytics of growth are very complicated. It's not simply are we growing, yes or no. It's exactly where and how and what's going on with our distributors, what's going on with our customers. So one of the first things, now this is a model that McKinsey applied to all industries, to just ask the question, when you look back over the last decade, where has growth come from? And it breaks growth into three categories. One is portfolio momentum. Portfolio momentum basically means assume that you have industry average growth rate wherever you are. How much lift you get because of the market you're in? So if you were in specialty lines over the last decade, you got a very strong lift because E&O and D&O and all other forms of professional liability and other specialty lines grew much faster than inflation. If you were in personal automobile, you had a drag. So that's portfolio momentum. And then there's M&A. And essentially, M&A has been a pretty inconsequential factor compared to most industries. The first time our strategy people ran this chart, they said, you must have screwed up the data. I said, what do you mean? And they said, we can't find a single industry where M&A isn't bigger than organic growth. And if you think about it, M&A in the U.S. essentially is Travelers, a couple of deals done by Liberty, and Berkshire Hathaway's acquisition of Gen Re. Take those 5 deals out, and that number gets shrunk to probably 1% or 2%. So essentially, growth in this industry is all about organic growth. If you look at the spreads among companies, you can see organic growth is far and away the dominant, with from top to bottom a swing of close to 16 percentage points per year of annualized growth, difference between the top performing organic growth companies and the lowest performing. Now getting good at this is going to require a couple of things. Where is the analytic talent in most property casualty companies? It's in actuarial, it's in finance, it's in product management. How much of it resides in marketing, sales, distribution? Very little. Those functions are largely relationship-oriented, and that is an important part of the equation. So we would argue that becoming really good at the analytics of growth is going to require an infusion of analytic talent, because we would argue that the complexity of understanding growth and its drivers is at least as great as it is on risk. The next barrier is the incentives and management processes are not aligned. Most companies are driven by annual earnings targets. That's what the planning process revolves around. And they're also driven by annual incentives. When you look at growth initiatives, we would argue even the simplest growth initiatives typically have a 3-year lead time. And if you're talking about developing new markets, more like 5 to 10 years. So what happens when a company is squeezed on its profitability and everyone's incented based on annual earnings? You squeeze out the investment dollars in growth initiatives. So that to us is the next barrier that has to be overcome. And then the final one is, this is not an industry that has many business builders. If you think about the vast majority of companies manage themselves with a matrix. And therefore, the most talented managers grow up the managerial curve. 2 companies that have taken a totally different approach to this and have grown an enormous number of entrepreneurs and new businesses as a result are AIG and Berkeley. You know, Hank Greenberg at AIG had no problem having 3 or 4 different E&S operations running around competing with each other. But the notion was, you own the business, I've given you the capital, make me rich, I'll make you rich. And there were very skewed incentives that had the lift of AIG stock. Bill Berkeley's done exactly the same. Berkeley has probably 31, 32 different businesses, frequently teams that were recruited from other companies, and they are run very independently and compensated based on what they deliver. So one of the real challenges in getting a growth engine going in this industry is where the business builders and growers actually going to come from. We think it's a solvable problem, but it's going to take time. So what I'd like to do, and I'm going to pick up the pace a little bit because I want to turn it over to Sasha on Canada. There are 3 growth levers at the consumer level. Retention is an obvious one, extraordinarily important because we all know that renewal business runs a lot better than new business. But the economics of retention, what drives defections and what you can do about it, very complicated question, even how you measure it. The second one is cross-sell rates. How many companies can factually answer the question, in what sequence do individual consumers and businesses buy different product coverages? Where have cross-sell initiatives or upsell initiatives been successful? What is the cost of running those campaigns? What's the payoff? And then finally, brand. Brand is becoming increasingly important in the U.S. If you look at the expenditures, which is largely focused on personal automobile, but when you've got companies like Geico approaching $900 to $1 billion a year in brand spend, the gecko is probably one of the best-known advertising symbols across all of the U.S., the caveman, the same. But you can see branding is becoming increasingly important. This one I'm going to skip over, other than to say this shows basically when you look at people who bought through each of the 3 sources, starting with the agents, and then ask where did they get the information? Where did they actually go for a quote? Not many companies have this kind of information, and yet it has an enormous impact on how you think about what you're doing with your website, what you're doing with call centers, what you're doing with your agents, and how all of that comes together in an integrated way. Again, just to illustrate the complexity of getting the analytics right on the growth side. On the distribution side, obviously appointment strategies and what your agency footprint is going to be. You know, I had a client that said, we know exactly what we've got, what business we want, and we have access to it through our producer plan who's been stable forever. And I said, okay, in the state of California, what proportion of the market in your target market does your current producer plan give you access to? Seat of the pants answer, 90%. Factual answer when we did the analysis, 5%. Again, because it's growth, not subject to the same analytic rigor. So if you look beyond that and look at the value propositions that you're offering distributors, there are a number of levers that you can play with on the distribution side that can offer enormous upside. This is a simple one, which is managing the marketing funnel, having real facts in terms of how much of the market does your producer plan give you access to. Of the business they have, how much do you get to see? Of what you see, how much do you quote? Of you quote, how much do you get? And what are all of the leakage points along the way, and what can you do about them? And then finally, new businesses. And in new businesses, you have international markets, where I would say on average are less sophisticated than the U.S. market, and therefore a lot of the insights and algorithms are transferable. You have underwriting or appetite adjacencies. So if you look at Progressive, they absolutely own substandard auto, went through a hiccup as they expanded into standard auto, but it worked for them, then expanded distribution from independent agents to go direct. Everyone said the agents will kill you. They haven't. And then finally moving aggressively into commercial automobile, focusing again on private passenger automobiles and small fleets. And they've done extremely well. So expanding into new channels, expanding into underwriting adjacency and international all offer significant growth upside. And then the last one that I'm going to skip over is just as you're never done the risk journey, we would argue you're never really done growing the 3 foundational pillars. What we've done this year is add IT as a 4th, because I think that IT has been used for many years primarily for generating accounting information and basic fundamental transaction processing. The huge opportunity we see available is to go beyond the mining that has been done through proprietary databases for risk elements to use predictive modeling much more extensively in underwriting and in claims, and then also to bring the power of IT to develop a much deeper understanding of consumer behaviors, so you know who buys what in what sequence for what reason, so you can develop the same level of analytic rigor on the growth side as there is on the risk side. So with that, I'm going to turn it over to Sasha to talk about what's similar, different in Canada and what it means.
When Pete first called me up after he spoke to Alistair about 6 months ago and said, we're going to do the journey for Canada, I said to him, I gave him actually the classic Canadian response. And the classic Canadian response was, Pete, we're not the U.S. It's different up here. It's different up here. We have a different industry structure. We have different ownership structure of our carriers, different regulations in Canada. We can't underwrite the same way that you guys can do in the U.S. And we're definitely not spending $1 billion a year on brand advertising. And Pete's response was, that's it? That's all that's different about Canada? Let's do the numbers and see what happens. And I think the conclusion of that analysis has been that, and I'll take you through the numbers, is that while there are a lot of real differences between Canada and the U.S., there are actually a lot of similarities as well. And paying attention to the similarities can actually yield a lot of insights in terms of where our industry is today and where our industry is headed in the future. So Pete started the analysis of the journey by talking a bit about a performance spread in the property and casualty industry. He basically asserted that there are winners who enjoy a great return on their performance, and then there's, let's call them the not winners, that are bearing quite a heavy penalty for not performing. And because of that spread in performance between the winners and the rest, there's an opportunity to look more closely at what the winners are actually doing and start to tease apart lessons learned. So it was a natural starting point when we started to look at the Canadian market to see whether or not that performance spread exists up here and whether this fundamental part of the journey exists. And as you can see, when we looked at the Canadian property and casualty market, the performance spread appears to exist in all its glory between the top quintile and other quintiles. So there was a clear spread between folks that are doing very well and being compensated and rewarded for that, and some other quintiles that are bearing quite a heavy punishment. So the spread in Canada appears to exist very similar to what we've seen in the U.S. over many periods. The second very important, I think, piece of analysis that Pete then talked about in the U.S. was where is the money being made within the overall business system in insurance, teasing apart underwriting performance versus investment performance versus leverage, and to see can we tease apart and understand what is actually the drivers. And as we saw in the U.S., underwriting performance was clearly correlated to overall performance of the company. And as you can see in Canada, once again, it appears to be a very similar correlation, where you can see those top quintiles from an economic performance perspective also happen to be the top performers from an underwriting perspective. And again, this is overall margins, so looking at a very broad pricing, underwriting claims, versus investment margin, which seems to be actually de minimis in terms of its ability to predict whether or not performers are going to be high in the industry versus average. So again, it appears to be an industry where the winners are taking all, the winners are taking all the profits, and the winners seem to be making those dollars based on operating margins, very similar to what we've seen in the U.S. over time. Now, those are some of the similarities. Now, let's talk a little bit about some of the differences, because I think we do have a unique industry in Canada, and we do have a unique history of the companies that operate in the property and casualty industry in Canada. And one of the charts that Pete showed you was a correlation between growth and margin. that basically asserted that the industry in the U.S. has become quite disciplined over time, where high-performing institutions are performing well both on the growth and margin dimensions. What does that look like in Canada? So the R-squared and the correlation that we saw in the U.S. was 56%, I believe. So pretty strong correlation in general. In Canada, not so much. We actually see a bit more of a scattershot in terms of performance from a growth and operating ratio perspective. And I think it's quite interesting when we first saw this chart. A few insights jumped to our heads when we looked at it. First of all, there seems to be quite a bit of capacity that has not sorted themselves out from a risk perspective in terms of climbing the first mountain, the risk mountain. Still significant capacity that is underperforming. The second thing that jumped out, however, was there's an opportunity to climb the growth dimension as well. For carriers that are actually starting to do quite well from a margin perspective, and they need to start thinking about how they're going to climb the growth mountain. What are the levers that they're going to pull in order to do well? And then there's a few carriers in the top right quadrant that have a real opportunity to really turbocharge their business models and take it to the next level from a growth perspective and start to do well over time. Now, of course, when you look at these players, there's a lot of history, there's a lot of stories, there's a lot of things that go into the performance. But in general, this is an industry that does not appear to be quite as disciplined as we have seen in the U.S. A couple of other interesting facts that came when we were looking at overall industry performance. What you see here is when we do an inflation-adjusted analysis of premium growth, Canada versus the U.S., we see that we're a little bit more cyclical than the U.S. The downturn's a little further down, the peak's a little bit further up, so a little bit more volatility in the industry than we have seen. Again, regulatory changes. Modernizing the P&C industry in Canada, I would call it, has also had a pretty significant impact. But we've definitely seen more volatility over the last period. And then when we look at inflation-adjusted earnings in excess of the cost of capital, we actually see a pretty good period from 2004 to 2007 for the performance of the industry, only to lag back again over the last 2 years, where the industry has not been able to return its cost of capital. One very, I think, important kind of explanatory variable, if I could use that phrase, in terms of describing company performance along the growth and operating margin chart that I wanted to highlight, because I think it's important, is the remarkable difference in channel economics and the success companies have had playing in different channels in Canada versus the U.S. What you can see here is the blue dots are the U.S. Performance from a margin and growth perspective of different channels. You can see direct seems to be performing better so companies that are placing their business through that channel seem to be doing quite well. Versus brokers, and then there's some multi-channel players, and finally agency seems to be doing the worst. In Canada, you see, again, a similar spread, but it's even greater, versus where you see direct performing exceptionally well from a margin and growth perspective, and then multi-channel starting to creep up as well ahead of broker and independent distribution. So seems to be, is there a chicken or an egg there? Is it that companies were in the channels and then therefore they benefited from it? Or was it high-performing companies that started to move into individual channels and bring their capabilities? Whether it's a chicken or the egg, we actually found an interesting dispersion of performance based on the channel that they were placing that was even greater in Canada than in the U.S. So what does it mean when we looked at the Canadian market and compared it to some of the lessons that we've learned 20, 30 years looking at the U.S. market? Number one, for many companies, climbing the risk mountain remains job number one. As Pete talked about earlier, there is a great peril at climbing the growth mountain before you have clearly gotten your risk management skills in place. And in Canada, I think it's a particular challenge because of our regulatory structure up here, which is different than the U.S. finding out ways to get segmentation on underwriting and pricing in a more restrictive and different regulatory environment is going to be absolutely key. And I was actually quite excited when I saw that the next discussion today is all about that, because we think it remains to be job number one. That's for some companies. For other companies, we would say some companies have earned the right to grow, and they have actually are performing reasonably well from a margin perspective. And so the question they're going to have is very similar to the hurdles and growth levers and growth skills that Pete talked about are very relevant to the Canadian marketplace. So things like the cross-sell opportunity, the upsell opportunity, a customer-centric organization, product design are absolutely as relevant in Canada as they have been in the U.S. So many of the growth opportunities that we discussed in the U.S. are as relevant here. And then the last one is industry structure. We could be seeing exits. We could be seeing further consolidation in the industry as many foreign players that have typically owned capacity in Canada look for more, basically try to rationalize their investments more globally. So those are some of the implications for Canada. I think we still have a few minutes, so would love to take any questions, Pete and I, from the audience.
I understand it was a big lunch, so we totally understand. Size?
I was wondering, it's Eamon Hoy speaking. I was wondering if you have any comments with respect to size. In other words, do smaller companies do better than larger companies, and is it really a matter of size when we get down to the results, particularly in underwriting, and then secondarily in the growth? Thank you.
Well, I'll answer from the U.S. point of view, and then Sasha from Canada. Absolute size, I would argue, in the U.S. is largely irrelevant. It's all about size in chosen market. So we have some relatively small specialty companies that have very strong positions in fairly narrow geographic areas that do exceptionally well. We continue to have local companies that have unique relationships with their producers, also are very close to the regulatory environment in a way that the national companies struggle to do. And if you go back to the fact that the economics are all around underwriting results, whether you give up a point or two or three in efficiency in terms of your expense ratio, we would argue in the big scheme of things, when you look at the spreads in performance, is relatively less significant. So now that doesn't say there aren't big companies that have enormous strategic advantage, because the way they've grown themselves is through a collection of quite focused businesses. And I would argue that AIG, which apart from credit default swaps is still one of the top performing companies in the world, in the property casualty world. But they basically were made up of probably 150 different unique profit centers, none of which were a big company by any premium measure, and yet did exceptionally well because they were so close to their markets and so focused.
And from a Canadian perspective, actually mathematically it's very easy to post large growth rates when you're off of a very small base. So we first looked at that actually to see whether or not that was skewing the results. And when we looked at it, we actually found a very similar story to what Pete describes in the U.S., where at the end of the day, looking at the actual margin improvement was really what we were focused on. And when we segmented it big versus small, we weren't able to see any significant correlation between the two.
My question is for Sasha. Sasha, on one of your slides where you were charting growth in Canada versus underwriting skills, at the very top right corner you had direct companies, and in the bottom left you had agency companies, the companies that rely on agencies for distribution. What are the implications for the broker channel in Canada? It seems to me that the companies that rely exclusively on direct are just killing the others.
Well, let me nuance the comment a little bit. I actually, if you look at those companies in the top right, it was a mix between pure direct, but also some multi-channel players in there that actually have significant businesses still through the broker channel. So I don't think the implication from that is just you need to be a pure direct player in order to grow. I think the implication for us is that if you have a significant business in the broker channel, it's important to have a multi-channel capability over time. I think the growth of the direct business in Canada is real, is significant, is going to continue. We can have debates as to how big that number is going to be, but it is going to continue to grow. And so our sense is that companies that have a footing in both and can manage a footing in both are probably going to be best positioned for growth in the future. Incidentally, in the U.S., Progressive is a good example of a company that has managed to grow profitably in both channels by having a pretty strong broker value proposition through their technology platform and through good broker service, while at the same time growing quite well over their direct channel. So our sense is, at the end of the day, that's probably longer term where companies are going to need to be.
But it is largely a personal line story. We do not anticipate and have not seen in the U.S. any meaningful inroads of direct operations into commercial lines.
Yes, do you have some insights into the lesser emphasis on branding here in Canada? And we're seeing more of it now, but why we've been so slow to move towards emphasis on branding as in the U.S.?
It's a good question. I think part of the answer to that question has been many of the bank-owned insurers already enjoy pretty favorable brand recognition amongst consumers without having to spend much. So RBC, for example, TD is another example. Those companies haven't had to invest a whole lot because they've already got 98% recognition amongst customers. Versus if you look at Geico in the U.S. and Progressive in the U.S. and a lot of these, they had to build a brand from scratch. So I think that probably explains a little bit of the history. I think what you see a lot of the spending now starting to creep into Canada is where players are trying to build brand recognition for a new brand that they're putting into the market. And I think it's fair to assume, especially if they're building a de novo brand, especially if it's consumer direct based, you're going to continue to see growth in this. Probably not reaching what you see in the U.S., given the size of our market, but probably a significant growth over time.
It sounds like you don't feel the industry, for the most part, has done a really good job around product analysis and analyzing customer needs. Which industries do you think our industry should look to learn a lot more about this very important area?
Go ahead, Mike.
Well, I think the best, in the U.S., you would have to say a combination of the retailers and the consumer goods companies. In terms of brand, in terms of understanding consumer behavior at a very micro level. If you look at the frequency of format changes of the successful retailers, they're constantly reinventing themselves. Now, they have the advantage of literally they can see the customer, they can track them, they know what they're doing, and they can match it with lots of external data. I'd say the banks are getting better on the consumer side. Obviously, they have a hole to dig out of, given what happened with subprime and what happened with credit cards and management of liabilities. But I think their knowledge of consumer behavior, because they're typically dealing direct as opposed to through intermediaries, gives them deeper insights. But frankly, our guess is if you could get inside the marketing and customer engines of a Progressive and a Geico, they're probably as good as anybody in that, not just in the insurance space, but would be world class on a lot of standards. So we don't think this is necessarily creating something that hasn't been created. If you go back to my point that the analytic horsepower and the senior management attention on growth and being as disciplined about those levers of growth that we talked about is clearly available to any company that chooses to go after it. But providing the analytic horsepower behind it and the databases required to generate the facts is going to be important. Okay, I think we're about at the 4:30 mark, so. No, sure.
Yeah.
As many as people would like.
Just on the investment side, in terms of doing a deeper dive, in terms of looking at the investment risks in some of the companies that you profiled, were there any kind of trends or conditions that actually made an insurance enterprise a little bit more successful as it relates to the asset strategies that they were pursuing?
It was the investment?
Yeah. Drivers of performance.
I mean, in the U.S. portfolios, by and large, are relatively conservative. The big elephant in the U.S., obviously, is Warren Buffett and Berkshire Hathaway. And he's had a truly unique track record, especially when you consider the scale of the assets under management. But I think if you look at how little the P&C industry was hit by the financial meltdown, was an indication that they don't go very far out on the risk curve, and certainly during the meltdown that served them very well. I think you would also see that their positioning in equities tends to be far more conservative than the big European players. So in general, I think the philosophy has been there's so much risk on the liability side of the equation. Do we really want to take it in the portfolio? Again, with the huge exception of Buffett, who was, we would argue, is unique.
Great, thank you.
Okay.
Well, thank you very much to both of you. Obviously, in the interest of time, we're cutting you off. You're clearly fascinating this audience, and I'm sure there will be many more questions. As we have with our other speakers, on your behalf, a donation has been made to Women in Insurance Cancer Crusade. I've got both of your certificates here for you. But just once again, everybody, Peter Walker and Sasha Guy, our thanks. We are going to ask you now to make your way down to the fortifications room on the 9th floor. More or less immediately, our next speaker, our next panel will begin. And so if you can make your way there, we'll get underway within about 10 minutes.